Markets have been strong, almost too strong. Every major asset class has been climbing. Stocks, real estate, gold, even crypto, they've all been in motion together. But when everything rises together, that's usually a sign we're closer to the end of the expansion, not the beginning. And that's what I believe we're seeing, the late stages of the bull market. It's the part of the cycle that looks the most convincing, the most euphoric, but also the most fragile. Because it's during this phase that the problems start to build, quietly, beneath the surface, long before anyone realizes what's coming next. You won't see it in the headlines. You won't hear it from the mainstream. But history shows every major market peak is born from this type of environment.
That sense of there is no limit, and that all this expansion, this success, this elan, we're not really going to have to pay for it. Now, of course, that didn't turn out to be true. You could see the crash. Why do you think they called it the crash? I mean, it's really an airborne collapse metaphor. You can't crash if you're never left the ground.
See, in every bull market, the problems don't appear after the crash. They're created before it. The imbalances, the leverage, the overconfidence, they're all built during the boom. We saw it in 2007 with real estate. We saw it in 2000 with tech stocks. And we saw it in Japan back in the late 80s. The late stages of a cycle always have the same feel. People think the central banks have everything under control. Corporate profits look fine, and investors start taking bigger and bigger risks. Because every dip gets bought. That's what makes it so deceptive. By the time the problems become obvious, the cycle has already turned. Right now, I don't think we're at the final top yet, but there's still time left in this cycle, and probably more upside in a few key markets, but we're getting closer. As we approach that top, expect things to get messy. Volatility will rise, we're already seeing signs of that. We'll see sharper pullbacks, wilder rallies, and much more emotional behavior from traders and investors. That's what happens when markets reach exhaustion. The fuel that's been driving them, easy credit, liquidity, confidence, begins to fade. And as it does, the emotional extremes start to show. You'll notice it in the comments, the media tone, the investor sentiment surveys. Fear spikes on down days. Euphoria returns just days later. That's the late stage signature. Chaos disguised as confidence. For the past few years, everything has moved up together. Stocks up, real estate up, commodities up, crypto up. That's what we call a liquidity wave. But liquidity doesn't last forever. Eventually, it starts to dry up. And that's when you begin to see certain assets break away from the pack. We're already seeing this. Gold hitting new all-time highs, copper previously hitting highs and then dumping, stocks continuing to climb higher, crypto taking off and then lagging behind. But that's not random. That's the market reallocating capital. Money starts leaving speculative assets and moves toward perceived safety or value. This divergence between markets is one of the clearest tells that we're nearing the later stages of the expansion. It's the market quietly saying, the easy money is gone. Now, let's talk about some of the traditional late cycle signals, and there are plenty showing up. We've got new highs in copper, which historically peaks near the end of the major commodity runs, the US dollar breaking down, often a precursor to instability or overextension in risk markets, new highs in global real estate, even as affordability collapses, and perhaps the most symbolic, the rise of debt-fueled vanity projects, the tallest buildings, longest bridges, biggest sports complexes. There are just too many to name. These are psychological peaks, physical manifestations of excess confidence. They represent how societies behave when they believe the good times will never end. And yet, all of them are built on the same foundation: cheap money and debt. That's not sustainable, and history shows it never is. There's one key ingredient missing from this cycle's final chapter: the all-in moment. That point where everyone, the average person, your neighbor, your Uber driver, is talking about the markets again, where speculation becomes normalized and people throw caution to the wind. We're close, but we're not there yet. At least, I don't believe so. The excitement is returning, especially in pockets like AI stocks and certainly property markets, but the broad public mania, the true top signal, hasn't quite arrived. When it does, That's usually the last push before the rug gets pulled. So where does that leave us now? We're in a window where opportunity still exists, but it's shrinking. The reward to risk is changing. This is where smart investors start thinking about protection, rotation, and transfer, not pure speculation. If you've built wealth during this cycle, now's the time to consider where that wealth lives. Because as fast as it's been made, it can disappear even faster. The coming months will likely bring sharper swings, more emotional noise, and the illusion of safety just before the floor gives way. That's why it's so important to stay level-headed, data-driven, and grounded in history. That's what we'll keep tracking here, week by week, as we navigate what could be the final stages of this massive bull cycle. If you want to stay ahead of the crowd, not chasing it, then make sure you're subscribed. We'll keep covering the major market rotations, sentiment extremes, and historical cycle comparisons so you can prepare before the next phase begins. Because the end of a bull market isn't the end of opportunity, it's the beginning of the next great wealth transfer. Stay focused, stay sharp, and I'll see you in the next one.